Welcome to The Debate. I want you to imagine putting a teenager behind the wheel of a Formula One car and telling them to just monitor the digital speedometer.
Yep. They are absolutely not going to do that.
Not a chance. They are going to drive entirely by the roar of the engine, the vibration in the steering wheel, and, the blur of the track rushing past their peripheral vision.
Right.
The actual data on the dashboard becomes completely irrelevant compared to that visceral rush of speed. And today, we are asking if day traders are doing the exact same thing with their capital.
It's a great analogy because when you picture a professional operating in a high-stakes environment, say a commercial airline pilot, the process is incredibly clinical.
They look at the altimeter, the heading, the weather radar, and they make calculated adjustments based entirely on objective data. The inputs on that dashboard tell a very specific mathematical story about altitude and airspeed.
Right, and they execute a trained procedure based on those inputs, completely without any emotional attachment to the violent turbulence happening just outside the window.
Exactly.
But if you put an untrained operator in that exact same cockpit, the flashing warning lights on the console, they don't signal danger. They signal excitement. Pushing the nose of the plane down feels faster, so they do it. The actual data becomes entirely secondary to the physical rush of the dive.
And that really sets up the core analysis of our discussion today. The premise that the primary driver behind day trading decisions is often the pursuit of adrenaline rather than the logical execution of price action.
Right, because day trading is universally described as this highly technical game of charts, precise entries, mathematical levels.
Yeah.
Yet for a vast number of market participants, the real force dictating their capital allocation is that physiological rush.
Well, I represent the perspective that the breakdown we see in retail traders is really about cognitive narrowing. It's a biologically induced false urgency. Adrenaline's primary danger is how it physically distorts risk perception and narrows cognitive attention. This is a structural processing error within the human brain, rather than a conscious, pure thrill-seeking endeavor.
And I take a much harsher view. I argue that traders operate primarily to satisfy an emotional need for stimulation. To actually succeed, they require a rigid, almost punishing embrace of absolute boredom. The excitement actively replaces the analysis.
So you think they just want to be entertained?
Basically, yes. Let me lay out my perspective on this. When you look at how retail traders actually behave in the wild, the entire objective of their trading session routinely mutates.
Mutates how?
The goal subtly changes from executing a mathematical edge to just feeling something intense. You see this everywhere. Traders become incredibly attached to the powerful rush of a fast-moving candle, a sudden breakout, or a rapidly fluctuating profit and loss column.
I mean, it is a fast-paced environment.
Sure, but they will actively choose to enter incredibly weak setups simply because the market is quiet. They literally cannot tolerate the absence of action. They will increase their position size immediately after a winning trade, not because the math dictates it, but because they are chasing a larger dopamine high.
Right, but...
That's to finish the thought. The trades that feel the absolute most thrilling, buying right after a vertical, violent move, or entering a breakout before it confirms, those routinely have the absolute weakest risk-to-reward ratios. It is an emotional dependency on the rush itself.
That is a compelling argument. But have you considered the biological mechanics of what is actually happening in the brain when a trader is sitting in front of a flashing screen?
I have, but I think it's often used as an excuse.
I don't think it's an excuse at all. I am not convinced it is merely an emotional dependency. Adrenaline literally distorts reality. It changes how risk is perceived on a physiological level. We have to talk about the amygdala.
The lizard brain.
Exactly. It's our brain's primitive alarm system designed to keep us alive in the wild. When volatility spikes on a chart, the human brain perceives that rapid movement the exact same way our ancestors perceived a predator running through the brush.
A flickering candle is not a tiger.
To the prefrontal cortex, no. But to the amygdala, yes. It triggers a massive release of adrenaline and cortisol. And when a trader is flooded with that adrenaline, a controlled, mathematically sound trade actually feels far too slow. It feels wrong.
Because they want fast trade.
Now, because an oversized position feels important, the body is signaling that the stakes are a matter of survival. A patient setup is ignored for a volatile stock moving quickly because the brain's threat and reward center is prioritizing immediate movement. The failure is not just seeking a thrill, it is the biological reality that adrenaline creates a literal belief that the trader must act immediately or face dire consequences.
I see why you think that. But let me give you a different perspective. If this were purely a biological misfire, an unwanted hijack of the prefrontal cortex, then traders would step away the moment they realized their judgment was impaired.
But the impairment prevents them from stepping away.
I disagree. When excitement replaces analysis, it looks absolutely identical to a classic addiction loop. If you are operating from a place of stimulation seeking, you judge your session by how exciting it felt rather than how closely you followed your parameters.
But how do you prove that's thrill-seeking and not just panic?
Look at the specific behavioral symptoms: feeling immense frustration when there are no trades, blindly entering a position just because the market feels active, and the most destructive of all, revenge trading after a loss. These are not signs of a malfunctioning calculator or a simple processing error. These are signs of someone who is desperately trying to engineer a specific internal feeling.
I agree, those exact symptoms exist. And yes, they are incredibly destructive, but I interpret their origin differently. When adrenaline hits the bloodstream, traders focus exclusively on the immediate movement of price. They develop severe tunnel vision.
Literally.
Literally. The pupils actually dilate to focus on the immediate threat, which in this case is the flickering price on the screen. Because of this physiologic cognitive narrowing, they completely ignore higher time frame levels. They ignore the volume profile, broader market conditions, their own daily risk limits.
So they just forget their whole plan?
It is not that they're consciously saying, I want a thrill instead of a profit today. It is that their narrowed attention cannot physically process the vast amount of information required to make a profitable, logical decision in that exact moment. The prefrontal cortex, which handles all that complex logic, is practically offline.
I'm sorry, but I just don't buy that line of reasoning because it completely ignores the cyclical nature of the behavior. If you connect the dots between the win and loss cycle, it tells a different story.
Go on.
Think about a casino. A slot machine is specifically engineered with lights and sounds to create a dopamine response, regardless of whether you win or lose. In trading, a win creates a massive craving for another rush. A loss creates an intense craving to fix the psychological pain immediately.
Which causes them to overtrade.
Yes. Both of these outcomes push the trader into another position before they have taken even a second to reset mentally. If a win creates a craving for another rush, and a loss creates an intense craving to fix the pain immediately, isn't this identical to a chemical dependency cycle?
I wouldn't go that far.
Why not? When someone abandons their entire business plan simply because volatility rises, they are doing so because the emotional rush has entirely replaced the cognitive process. They want the high. If it were just a structural processing error, why the revenge trading? Revenge trading is a specific desire to inflict pain back on the market or get the high back.
I hear you, but labeling it an addiction cycle dismisses the immense power of the false urgency that adrenaline manufactures. Yes, they dive right back in 30 seconds after a loss, but why?
To get the thrill back.
No. It is because the cortisol and adrenaline are still pumping through their veins, screaming that they are in immediate danger. Adrenaline creates a literal sense of urgency. The trader genuinely, physically believes they must act right now to survive the situation.
Survival? By buying a stock?
Biologically, yes. This leads to late entries, poor sizing, impulsive decisions. It is a false alarm sounding in the brain. When that alarm rings, the cognitive machinery breaks down. It is an inability to manage the perceived urgency. The market rewards process, not intensity. And a professional process relies on navigating uncertainty without letting that false biological urgency take the steering wheel.
Well, let's explore that professional process, specifically what I call the strategic advantage of boredom.
I like that phrase.
If we accept that the market rewards process over intensity, and that excitement triggers these dangerous biological responses you mentioned, then good trading must be inherently boring. And I mean profoundly, painfully boring.
Absolutely. A professional process may feel incredibly repetitive. Think of it like a quality control inspector on a factory assembly line.
Right, just stamping widgets.
Exactly. The setup appears on the chart, the mathematical risk is defined, the trade is taken, and the result is accepted without fanfare. That sequence of events may not make your heart pound, but it is sustainable precisely because it does not trigger the amygdala.
And when they step off that assembly line,
When a trader operates outside of that calm, methodical process, overtrading massively increases transaction costs. It multiplies unforced mistakes, and it exposes the capital to exceptionally weak setups. Planned trades very quickly become tangled up with emotional, impulsive ones. Whatever statistical edge the trader had is entirely lost.
which completely proves my point that tolerating boredom is the ultimate shield against emotional hijacking.
I wouldn't say it proves your point about thrill-seeking, but it is a shield, yes.
Look, modern society conditions us to be terrified of boredom. We have smartphones in our pockets delivering infinite scrolling and constant microdoses of stimulation. When a trader brings that need for constant stimulation into the market, it is fatal.
It really is.
Waiting for confirmation, using the exact same risk parameters every single time, skipping poor setups, none of these activities are exciting. But this boring trading protects capital. The brain naturally hates boredom and will try to fabricate patterns out of random noise just to give you a reason to click the mouse.
Yeah. Seeing a setup where there isn't one?
Exactly. Traders who can tolerate this boredom are vastly less likely to chase moves, they are less likely to revenge trade, and they are less likely to manufacture opportunities out of thin air just to feel something. They have accepted that their job is not to be stimulated.
I agree with the immense value of boredom, but I want to introduce a crucial diagnostic check here that speaks directly to the cognitive distortion I am arguing for.
All right, let's hear it.
It is easy to say just be boring, but how does a trader actually do that when the chart starts flashing rapidly? There is a very specific question they need to train themselves to ask in the moment. Would I take this exact trade if the market were moving slowly?
Oh, wow.
Right? This question is absolutely necessary to separate a valid logical setup from the mere biological attraction to market speed.
That is a fascinating point, though I would definitely frame it differently. That diagnostic question is a brilliant filter, but it is ultimately a tool to combat the internal emotional desire for speed. It forces the trader to confront whether the setup is mathematically valid or if they are just reacting to the flashing rights of the tape.
Precisely. Because if the honest answer is no, if they would never touch that setup in a slow, grinding market, then it means their attention has been completely hijacked by velocity. The speed itself has bypassed their analytical filter.
So the question forces a reset.
Yes, asking that question forces the brain to zoom out. It engages the prefrontal cortex again. It interrupts the adrenaline response by demanding a logical, verbal justification for the action. It is a vital way to recalibrate their distorted perception of risk back to reality.
But is a simple mental question enough? I mean, think about a choppy sideways market session. Were you calm, or were you itching to click the mouse just to make something happen? Because if the desire for stimulation is the root cause, asking a diagnostic question is just putting a bandage on a glaring vulnerability.
So what is the actual fix then, in your view?
We have to talk about the actual mechanics of protection. How do we reduce adrenaline-driven trading? It requires strict, unyielding mechanical rules. You must clearly define your valid setups before the session even begins.
Okay, planning ahead.
Yes, and you must set a hard maximum number of daily trades. You must use fixed risk on every single position. You can never increase your size just because you feel confident or because you are on a winning streak. And you must mandate physical breaks away from the screen after large wins or large losses.
Those are very rigid.
They have to be. These are rigid mechanical constraints designed to put a cage around the emotional animal.
I'm sorry, but I just don't buy that a rigid cage of rules is enough on its own.
Really? Why not?
Let me tell you why. Charts, strategy, and risk management parameters matter, yes? But none of them work when adrenaline overrides the plan. You can have a sticky note on your monitor telling you to take a maximum of 3 trades. You can have a daily loss limit written on a whiteboard behind your desk. But when the tunnel vision sets in and the false urgency peaks, that sticky note becomes literally invisible.
Because they choose to ignore it for the thrill.
No, because the logical part of the brain that reads the sticky note is shut down. That is why qualitative emotional awareness practices are the actual saving grace here. Mechanical constraints fail the moment the brain decides survival is on the line.
I'm not convinced by that line of reasoning at all. If the prefrontal cortex is offline, as you say, how can we expect a trader to magically summon qualitative emotional awareness in the heat of the moment?
It's not magic.
If they cannot enforce a simple mechanical rule like stopping after 3 trades, their awareness of their emotional state is just going to be a well-documented diary of their failure.
That's a bit harsh.
But true. I question whether an emotional journal is truly enough to stop an adrenaline-driven trader from abandoning their plan when volatility goes through the roof. This links directly back to my core premise. Absolute emotional control, the complete subordination of the desire for excitement, is the singular advantage in trading.
That's the strong claim. But have you considered that qualitative awareness is not about magically fixing it in the heat of the moment? It is about building a compounding practice over time.
What does that look like?
You have to actively record the emotional reason behind each entry. You have to practice stopping the session entirely the moment you feel the physical symptoms of urgency. The racing heart, the shallow breathing, the muscle tension in your mouse hand.
Catching it early.
Exactly. The real edge is building that internal awareness. The trader who learns to recognize the physiological symptoms of adrenaline and shut down the operation has the ultimate advantage. So does the trader who can sit through a quiet session without forcing a position.
We agree on sitting through the quiet sessions.
Right. Mechanical rules are easily broken by an adrenaline-soaked brain. Qualitative emotional awareness is what actually applies the brakes before the brain gets completely soaked.
Let me challenge that reliance on qualitative awareness, though. How does journaling after the fact prevent a massive account blowout during the session?
It doesn't prevent it that specific day, but...
Right. Because if the desire for the rush is stronger than the desire to preserve capital, they will simply justify breaking the rules in the moment and write a lovely essay about it later. The market does not care how self-aware you are while you are losing money.
That is a fair critique of relying solely on real-time awareness, but you are missing the long-term compounding effect of that journal.
How so?
The process of recording the emotional reason behind each entry builds a vital historical dataset for the trader. When they review whether every trade followed the plan outside of market hours, when the brain is calm, they begin to recognize the destructive pattern of their own cognitive failures.
I suppose looking at the data sober helps.
Exactly. They start to see exactly how adrenaline damaged their decisions in the past. They see the late entries, the poor sizing, the incredibly impulsive decisions, all driven by the false belief that they had to act immediately. By documenting this meticulously, they train their brain to recognize the false alarm of urgency the next time it rings. It bridges the gap between the primitive amygdala and the logical prefrontal cortex.
Okay, I see the value in building that historical data set. It essentially forces the trader to confront the glaring divergence between their excitement and their profitability.
Yes.
When they look back at a month of data and see that the trades that felt the absolute most thrilling routinely had the weakest risk-to-reward ratios, they can no longer deny to themselves that they have been prioritizing stimulation over capital preservation.
They have to face reality.
Right. They have to face the cold, hard fact that they felt bored by steady, controlled gains and only felt satisfied by reckless volatility. The numbers do not lie.
Precisely. And that realization is the vital first step toward correcting the cognitive narrowing. When they train themselves to ask, would I take this trade if the market were moving slowly, they are actively fighting the tunnel vision. They are forcing their brain to zoom out, to look at the higher time frame levels, the volume, and the broader market conditions that adrenaline is desperately trying to hide from them.
They are recalibrating their perception of risk back to reality rather than the distorted funhouse mirror that adrenaline creates.
So, to summarize my position, in light of our entire discussion, recognizing the internal desire for excitement and actively, deliberately choosing a boring, repetitive process is the absolute only way to protect capital from emotional hijacking.
A fair summary.
The market is not a venue for entertainment. It is a venue for executing repeatable mathematical decisions under uncertainty. Traders who refuse to tolerate boredom will inevitably use the market to manufacture adrenaline. They will enter weak setups, increase size recklessly, and chase moves that have already happened just to feel the rush. The discipline to sit on your hands when the market is quiet is the ultimate expression of professional trading.
And to summarize my perspective, long-term success depends entirely on recognizing how false urgency and narrowed attention physically distort market reality.
The biological side.
Right. Adrenaline is a powerful biological response that physically alters how a trader perceives risk and opportunity. It creates an incredibly powerful illusion that immediate action is required, blinding the trader to the larger context of the market. Overcoming this biological hurdle requires constant, vigilant observation of one's own decision-making process. It requires the qualitative awareness to stop the session the exact moment urgency takes the steering wheel.
You know, I think where we firmly converge today is on the ultimate cause of failure. Most day traders do not fail because they cannot recognize a simple chart pattern.
No, definitely not.
They fail because they use the market to satisfy an internal feeling rather than trading the actual objective price action in front of them. Whether we view that failure through the lens of an emotional dependency on thrills or a cognitive breakdown caused by false urgency, the end result is exactly the same. The mathematical process is completely abandoned.
I agree completely. The technical elements, the charts, the complex strategies, the moving averages, they are entirely secondary to the human element. You can possess the most sophisticated, mathematically sound technical strategy in the world, but if you cannot sit through a quiet 2-hour sideways session without forcing a position, that strategy is completely useless.
It always comes back to the instruments on the dashboard. When you are navigating the market, you have to ask yourself if you are reading the gauges or if you are just pushing the throttle forward because you like the sound of the engine roaring.
Well said.
We encourage our listeners to critically evaluate their own motives and physiological responses during their very next trading session. Notice your heart rate, notice your breathing, notice your patience when the chart goes flat. There is certainly much more to explore regarding the intersection of market mechanics and human behavior in our upcoming discussions.
Trade the price in front of you, not the feeling inside you.
Keep your eyes on the altimeter, and we'll talk to you next time.